This is the Legacy Wealth Code podcast, helping you build long-term wealth and a lasting legacy through real estate investing, tax strategies, and motivational stories from some of the most successful and influential people out there. Here are your hosts, real estate investor and entrepreneur, Michael Notbaum, and real estate investor and attorney, Andrew Hook.
Hey guys, welcome to another episode of the Legacy Wealth Code. I am Michael Notbaum, and I'm here with my partner, Andrew Hook, and we're super excited today. We've got a close personal friend of mine, but I think he's got a really awesome story, has built a multi-million-dollar portfolio of properties, has been in real estate since 1988, and then had a development company starting back in 1992. So a ton of experience. Super excited to have David D'Onofrio with us today. So thanks so much for joining us.
Thanks for having me, Mike. Andrew, thank you both for having me.
Yeah, glad you can make it today.
As am I.
So why don't we start with a little bit of background? I know Mike jumped in and said 88 you became a broker, but what was what led you to real estate? Did you have a passion for it, or did you stumble into it?
Actually, I really didn't think about it too much until my senior year of college. I went to a small Jesuit school in Cleveland, John Carroll University. I grew up in a steel town outside of Youngstown, Ohio, about 60 miles north of Pittsburgh. So my senior year in college, I took a real estate course, and it just opened my eyes to real estate. And I said, one day I want to get into real estate, and I want to collect rent for a living. That's my goal. And so at that point, we didn't have the internet when I graduated school. That summer, I took 6 weeks off, and I packed up the car myself, and I drove for 6 weeks throughout the South. Went to different areas, Charleston, Charlotte, the Raleigh-Durham area, Chevy Chase. And I almost moved to Charleston, South Carolina. And it's 1985, and I called home to my mother, and I said, I think I'm going to give Charleston a shot. Big city, on the water. And she said, you're an Italian Catholic Yankee. You know nobody in Charleston, South Carolina in 1985, and that's going to be a big upstream swim. And your dad's always going to retire from Florida, so you got to at least go check it out. So I came to Tampa, and I said, man, Tampa's everything Charleston is, a little bigger, a few more Yankees. And that was it. And Tampa became home. So went back up, packed up the bags, came back down. I had no job. I didn't know anybody. But I knew this was a growing market, and if I want to get in commercial real estate, that's where I needed to go, to a growing, prosperous market. And so I got my first job with a company called Wegman Realty on the real estate side. Before that, I worked for a company called AllNet Communications for just 6 months while I was getting my real estate license, and that was great. It was a great background because basically it was a bullpen setting where you just sat there you're on the phone all day calling. That's right when AT&T and Ma Bell, they broke up, and you had all these long distance companies, and you're sitting there all day, you're calling, and you're getting told no 99% of the time, but no means maybe, and definitely no means possibly, and maybe means I'm going to turn that into a yes. So it was really good training, in my opinion, to get into real estate, because let's face it, you get a lot of no's in real estate, especially on the commercial side. So that's how I started. I worked for Wegman Realty for about a year, a smaller boutique firm, and I knew I needed to get with a national firm. So after a year, I moved to a company called Grubb & Ellis, a national firm based out of California, and I specialize in retail. And from that point, started brokering and got some good clients. Probably my best client was Chevron. I represented them on the disposition of their excess properties at the time.
Okay.
And, that's basically the start of it.
Okay, cool.
So then it looks like 1992, you started a development firm.
That is correct.
So one of the things that I always admire about you is, you've basically given yourself a path to freedom. I guess when we look at like what is legacy, what is wealth, a lot of people would say being able to choose what they do with their time. Coming to your poker nights and seeing a 15-foot tall grizzly bear in your man cave, you definitely, who also, side note, almost killed him when he shot it. It's a pretty funny story. But, giving your life the ability to do what you want with it is something that's, I think, probably, on the top goal list of most people when they start thinking about what does wealth mean to them. And I think part of it is, like you said, it's pretty simple. what you've done. You haven't, it's not like some kind of crazy formula. So walk us through what your investment strategy has been.
For me, my investment strategy has been when I started my development company. And I started after, if you remember back in that time period, Walgreens was just getting started on the freestands. And I put together a couple of Walgreens build-to-suits, but as a broker, I, flipped into a developer and I made, 1/30th of what the developer made. And that's when I said, okay, I can't do this. I gotta get on the other side of the fence here. Because the goal has always been to get the knowledge as a broker, get into development investment. And so on the development side, I actually went to Chevron, who I was representing, and we did not set the prices on their property. They had independent appraisers set prices. So I approached them and said, listen, I'm interested in developing a company personally, and I don't want to have a conflict of interest. So whatever price you guys listed at, there'll be no negotiation. I'll pay a full price if I can buy some of these. They were happy. They just want to sell the properties. So I started buying some and then developing, smaller, 6,000 foot building here, 5,000 foot building in Sarasota. And then I started assembling up by University of South Florida, the northeast corner of 50th and Fowler. And I have a multi-parcel type development there with student housing and retail in the front and other retail centers. But my goal has always been to develop and hold. And the reason is it's a forced savings plan. I had friends and great guys, and they were blowing and going. I mean, I remember back in 07, 08, they're doing $300 million a year in development. And then, the music stopped and they were in big trouble. We saw a lot of people go down in that 08, 09 time period. Mm-hmm. And I looked around and I learned a lot, but I had very low leverage, and everything was on short-term amortizations to get paid off. And, it's sort of like how you're brought up and how you want to live your life, but you got to look at it like, at least the way I looked at it, I'm never going to have a jet. I'm okay with that. But as Michael said, it's about lifestyle. It's about having a great lifestyle. And what is value? Value is your time and your health, especially the older you get. Those are two most important assets you have. But you have to have the means to do the things that you want to do. And for me, my philosophy was, develop, hold. It's a forced savings plan. So even though you develop this building over here, and let's say it's worth $1 million, and there's $500,000 in profit or $400,000 in profit in it, you didn't put that money in the pocket. You're not going to the Hard Rock, what some friends like I know would probably do.
Why are you looking at me? Why are you looking like that?
I have no idea why I'm looking at you. None. But it's a forced savings plan. And so then you're living off the cash flow. And then as time goes on, you get them paid off when they're paid off. And even before, because when you're developing, it's not like going out and buying. You're the manufacturer of the product. So, typically, I was not a high volume developer, but when I did a deal, it was a fat deal.
So walk us through, when you look at a deal, what are you looking at? Are you using cap rate? Are you using cash on cash return? What are the metrics that you're looking at to determine this is a good deal, this is a bad deal?
Again, on the development side, I was site driven, especially on the retail side. To me, it was about site. If I love the site, I'm buying the site. And then, of course, I have my pro forma, and I'll make it work. For example, I developed a center in the Panhandle in Pensacola at Davis and Creighton. And I bought it from a guy, Fazoli's, a restaurateur, who just bought it from, I think it was Mobile. And I looked at it and I said, man, I can make this work. One of my tenants from Sarasota wants to be up here. It's going to be roughly a 12,000 foot building we're laying out. But we created value at that time period different from what the locals thought, because it was the first or second underground retention development in that market. Everyone thought that it could be only a 5,000 to 6,000 foot building, and we built 12,000 feet on it because of the underground retention at the time. So the value, and they laughed at me. The appraiser said, you've got to let me show my numbers, because I had Gateway Computers and Cowshamel Big and Tall is the two national tenants at the time in there. And he said, you were the laughing stock of Pensacola, because you paid double what the other guy paid for 2 years earlier. But then when I look at your numbers, it made sense. So you have to look at and especially in retail, or almost in anything, it's got to be the site. You got to love the site. Those are the basics of real estate. You don't want to have C real estate. If you develop C real estate, in my opinion, sell it. If you've got A sites, you don't sell the Mona Lisa. You keep the A sites. And, hold them, pay them off. And then you got all that cash flow. And then you could Go bear hunting.
Go bear hunting, mountain lion hunting.
Yeah.
You name it. He's got
Whatever-
he's
whatever
got
the
the
enjoyment
animal hanging
is.
in his man cave. It's there.
Talk to us a little bit about structuring a deal from a standpoint of, especially starting out. A lot of people listening are kind of in their preliminary project. So, from a debt standpoint, from a capitalization standpoint, how did you structure your early deals?
Because I was site driven, and then I'd pull in the tenants, and I did not do what I would call deals that were marginal. I knew if I bought the site right, if you buy the site right, you buy the land right, you'll be okay. Once you overpay for the dirt, you're in trouble. Okay. So it was just putting the deal together. And again, I was fortunate because I'm developing deals that I go to the bank, and the reality is, it's appraising out at, the loan's appraising out at 60% loan to value.
Okay.
All right. Because I bought the dirt right, and obviously negotiated the proper deal with the tenants. And then you're putting a short amortization schedule on there, which, lenders love that also.
Sure.
So every deal's unique. Every deal's different. As I told Mike, I've sort of been sitting on my hands for the last 18, 19 years. We could all look back and say, God, I wish I'd done this and wish I'd done that. Trust me, But when I saw '08 happen, and I saw people flying in their jets, burning and crashing, and I have 3 young daughters, I'm looking around like, you know what, life's pretty good. I just don't want to mess it up. But I do regret not getting back in the game hard. A lot of guys are running with Dollar General, and a couple other guys, the mattress firm deals, all that stuff. And they're cranking them out. And I wish I'd have probably jumped back on that. Now there's going to be lower margin deals because, the world's changed a lot in the last 10, 15, 20 years. So even though, to my knowledge right now, none of the main players are really blowing and going like they were, like the CVSs, like the Walgreens, a lot of those guys would restrict the money you would make. CVS, for example, I think they were like 150 to 200,000 max.
Wow.
Dollar General, $100,000. I know, but the guys were doing 15, 20, 30 of them.
Sure.
So it was a volume game for them. Okay. I just didn't get into that. I'd much rather, if I love the site, I'm buying the site, and then I'll work it out with a tenant. Now, retail's changed. The internet has changed retail quite a bit. So in industrial, man, that's the place to be.
Mm-hmm.
I wish I had all industrial right now. So each deal is different. Make sure you got a great site. That, to me, that's the primary thing.
Okay.
So you've been probably 2, maybe even 3 full real estate cycles since you first started?
Yeah.
So what do you think? Obviously, we were on the, you could pretty much put something on the market for the last 5 or 6 years, and you'd have 50 offers by the end of the day. So we're moving into a very different market. What would you say to an investor that's maybe just starting out, or you've got limited experience as we go into this cycle? What would you tell them in terms of what should they be looking for?
Well, first, let me say, if I don't have a crystal ball. If I did, I would have that jet. But so I don't, let me put that out there. But you have to look at the fundamentals. You got to love the dirt. You got to love the site. You got to love the real estate. If that component isn't there, don't do it. I'm just not a C market type person. Now, I'm not saying you can't make money in it. More properties are, and again, I'm thinking of retail when I say C locations. You're talking warehouse or office, most of it's, homogeneous, so it doesn't really matter as much. But you have to love this site. And just like when you're developing, you can't overpay for the dirt. Any deal out there on the acquisition side, if you overpay thinking, okay, but we're going to get the rents up in 5 years down the road, well, guess what? Look what's happening now. Interest rates are popping up. Cap rates are going to follow. I'm just not a believer in that. That's how you get your hand caught in the cookie jar. So you got to buy it right. You don't have to be a high volume person. And those are the basics. Stick to the basics on it. Site selection, good tenants, good visibility, good ingress and access. Make sure something's not happening with DOT down the road after you buy it. And they're like, oh my gosh, now they're closing the access lanes. You didn't even know it. Do your research there. Good demographics. And we're fortunate we live in Florida. Let's face it. I mean, if you look back at previous recessions, I remember the 2000 recession. It was a speed bump here compared to many other parts of the country.
Mm-hmm.
And so we have that helps us out a lot. But in the last few years, I question the values that people have paid on a lot of stuff. And I may be wrong, but I just think a lot of people may regret some of the numbers they were paying across the board. 3.5, 4 cap rates on stuff. I mean, come on, that's crazy.
Yeah.
When right now you can buy corporate bonds at 6.5, 7.
It has been hard to wrap your head around the last few years for sure and what prices have done. We've talked a lot today about the mindset of develop and hold. At one point, you told me that you can count on one hand the number of properties that you've ever sold. I'm just curious, what have you let go and why did you let those go?
Gosh, I remember I did a Payless build a suit with a buddy of mine way back. And we were partners, and it was just a small deal, when I just got started. And I'm not a big partner fan. I really don't have partners. I own some apartment complexes, partners with brothers, a long time ago, got into those. But I was just not a big partner fan because usually things just, one person wants one thing, one person wants something else. And I wanted to 1031 exchange that money into another development that I was working on. But so I'm not a big seller. I just hold my properties and collect rent. And when I think, man, I should have sold it, and then I look back and 3 and 5 years later, especially on the residential, and I own student housing, you can see the rents really popping up now, which is helping out on the residential and student housing side. Retail, if I had to do it over, I would have sold some and gotten into industrial. That market, because of the internet, is really taken off. Really taken off. So you got to be in the right sector. You got to have the right real estate. And those are the main components.
So over the course of your 30 plus years career, what do you think the biggest challenge has been for you?
Local governments. It's a nightmare. I tried to do a second phase of my student housing project 5 years ago. And even though I'm on 50th Street, I'm right across from University of South Florida on the first phase. It's a mid-rise 7-story building. And then behind it, that land is in Temple Terrace. And so I had the properties under contract. I met with 2 of the 5 commissioners who said they would support it. And, when I went in front of them for the hearing, you'd think I was a child molester rapist, the way that I was treated. It was brutal. It was bad. They all turned against me. I mean, just the commentary was ridiculous. And, it's like, geez, I'm just adding 36, student housing property units here. That's it. Really? 120 extra kids. The school's right there. The access is right there. We're closing everything off. So, and, I got shut down. Spent a lot of money and a lot of time. Government and government regulations. When you have 3 people with a sign sitting there screaming, "Oh my gosh!" Like, guys, we got a wall. We got all this stuff up that's going to buffer you, and we're already here, and there's no complaints. So it's government and regulation. Those are the most difficult things. And like I said, I've been on the sidelines on the development side. As an equity partner, I backed some people on some developments. And I look at it like, my gosh, 3 years to do a 2-parcel deal up in North Carolina. It's COVID was involved, but even then, it just takes forever. And you really, if you're going to develop something, you really need to have a lot of time in your pro forma, because things happen and they will happen.
Yeah. One of the things that we consistently hear clients talk about are tenant headaches and management of tenants. Do you in-house manage? Do you outsource that? And what do you find is the biggest challenge with your tenants?
We do an in-house. I have 7, 8 employees. I need 2 more bad, on the maintenance side and the leasing. I do have recently hired some outside brokers on the retail side, properties out of town. I do believe it's good to have a buffer in between the property owner and the potential tenant. If it's one small 1,200-foot space or something like that, that's different. But I think it's good to have somebody as a buffer. And it's tough. On the student housing side, every parent thinks their kid walks on water. The stories we could tell you, I can go on and you'd be shaking your head. And
I can only imagine.
Even my managers are like talking about the parents. I'm like, well, tell them what the daughter did. Like, no, I can't do that. I can't do that. And, on the apartment side and on the retail side, like I have one, I can't say who it is, but I have one tenant, their lease is coming up. I pray to God they don't renew their option because they are more work and more pain than all my other tenants combined, you know? So, but that's the game. That's part of it. Fortunately I have great staff who've been, my main people have been with me 11, 14, and 17 years, my top 3 people. So I'm very fortunate in that category. But yeah, you're always going to have problems with tenants.
Yeah. So somebody that wants to get into the development side, because a lot of stuff that we've done personally has really just been, I think we've done 2 developments, but I mean, they're just residential.
Mm-hmm.
And I think for us, the biggest challenge was finding the right people to put that deal together in terms of the construction, your general contractor, your trades. This is obviously on a much bigger schedule. And then, you had mentioned doing something up in the Panhandle. So how are you vetting who's going to be your builder and making sure that they're going to do work on a timely fashion, cost effectively, et cetera?
Well, fortunately, I was not building anything in a time frame similar to what we went through in the last 4 years where no one can hire anybody for anything. When I did the student housing and another one, I mean, we just caught the beginning of concrete going crazy, and the contractor told me if I built it, 6 months later, it'd have been extra $1.5 million just in concrete. Wow. I'm like, well, that wouldn't have worked. But if I had it in hindsight, I basically just, interviewed with and bid it out to multiple contractors, try to make sure that they were reputable. If I were to do it over, especially anything on the larger scale, I'm definitely going to have an owner's rep represent me to interface directly with the contractor.
Mm-hmm.
And you have to be diligent. You got to be on top of them. And yes, I've had problems, and we've had some litigation with the contractors who installed ACs wrong, and they're blaming the architect and blaming everybody else. But it's like, guys, you installed it wrong. the air is hitting block. It doesn't free flowing. So you're going to have that. And even now, crepe, I had my one property painted. And it's a 7-story building, and the painters, and it's a $150,000 paint job in a reputable company. And I said, well, where's the boom? I got to inspect this. Oh, no, we took it out or we're done. I said, no, get it back here. And they're like, we've never seen an owner hang off a boom going around the property. And guess what? They didn't paint about a third of the building. I caught in the back and their eyes are popping out. So you got to do that. I mean, they're going to do what they can to cut their corners every which way. So you got to be involved. You got to stick your head out there, and you got to be hands-on.
So has everything that you've done been ground up, or have you done any remodel?
Ground up. I own 2 apartment complexes that I acquired in South Tampa market. But after that, everything was ground up construction.
And that's obviously your preference.
It was at the time. If I were to get involved in a project, I'd, look at pretty much anything, but, rehabbing, I don't know, maybe if you found a house on the water, it's a different story. But the stuff I built, again, strip centers, things like that, is just ground up.
One of the things that Mike and I talk a lot about is kind of having passion projects, and we firmly believe that, while it's great to have the revenue sources and the basics of the fundamentals of making a living and doing what you really like is important too, and having those things that get you excited along the way. Of everything that you've done, what would you say has been kind of your favorite project or your best investment?
Best investment is probably the smallest deal I've ever done, which is a ground lease on a cell tower on my one retail project. I love it because, and I would say aside from industrial, if I could turn the clock back 30 years back when cell towers were just getting started, I'd run and do those like crazy because it's true mailbox money. It's wired to you. You got, AT&T and Verizon and T-Mobile up there and a couple other people. And the check just shows up and you never have a roof leak. You never have a parking lot problem. You never have an issue. And it's like, wow, this is so easy. And you get that check and you're like, my gosh, why didn't I just stick to this?
You do 100 of those.
Yeah, exactly. You don't even need that many, trust me. So anyways, I would say my baby, for lack of a better term, is my student housing project. For me, it was my biggest project, a huge risk. I'm building 2 shopping centers and a student housing project at the same time. Center in Pensacola, this one, and another 2-story building right next to it on Fowler. And I'm running around and I'm a one-man band. It's just me. I have no partners, no financial partners. And that's the key to what I was going back and saying earlier. For someone who's younger, who really wants to get in this game, you got to realize it's a minimum of a 10-year commitment. And if you're going to get on the development side and try and go the route that I went, at least, and hold properties long-term, yes, if you got an equity partner, I guess I wasn't that smart to get an equity partner, but if you get, that would really help. But you got to live lean. You got to live mean. I lived in one of my apartments until I was 36 and got married. Why? Because I had to save my money so I could use it to invest. I mean, one of the probably not so smartest things I did was I opened up a restaurant. I bought the franchise and built a Perkins at Fowler and 50th. And it made money. I mean, a lot of it was going out the back door. and now it's a mid-Florida credit union. I still own the dirt, so it turned out well. But I'd say the student housing is my baby of my projects. And just because, I don't know, it's my bigger project. And I just thought, it's my baby, I guess. It's not the most profitable. The retail is by far the most profitable.
Yeah.
But it'll get there.
So you had mentioned the cell phone tower thing. Do you see, obviously, like you said earlier, if you had a crystal ball, then you'd have the jet and we'd be on our way to go hunt something right now. But do you see anything else that could be similar to that right now that people should be maybe thinking about?
I do not. I do not. Especially on the retail side, and I would consider it's obviously cell towers, not retail, but it just, the world keeps changing and it changes fast. And retail, like I said, in particular, I have more vacancies in retail now than I've ever had. In 08, 09, I had 1,200 foot space, and now I got some space, and it's taken some time to lease up, and my rents are flat. And so true retailers are basically getting shoe stores and clothes. They're getting hammered by the internet.
Oh,
so
yeah.
A lot of retail space is now getting backfilled with, like, I have a center in New Tampa that was a Pier 1 when I built it. And now, it's Baycare it's 11,000. That box is an 11,000 foot Baycare. So you have medical, restaurants, you want hair and, nail salons, stuff like that you can't really get on.
I was going to say that's not going to go away. But I remember being at Busch Gardens with my daughter about 2 months ago. And for whatever reason, I'm standing in line for a roller coaster and I'm remembering all the things that I needed to pick up from the store. So I got on my phone, Amazon app. When I got home, it was at my house.
Yeah. That's
so it's like, you know what I mean? And it's very difficult to compete against that if you're
that's one reason why industrial is, sort of the king of the different sectors right now in the market.
So when you say industrial, give us some examples of what that looks like. Because I think that when, you say retail, it's fairly broad, but
industrial warehousing, let's face it, all these companies that are shipping stuff to us that we're ordering online, the Amazons of the world. And we're not smaller players. We're not going to be running with an Amazon right now. But I mean, all these other companies, they're making product and they're selling online, and they need space. And that's why people who are in that sector are crushing it. Mm-hmm. They're crushing it. Where I would not want to be right now is an office broker specializing in CBD markets. There's still going to be a pullback on that. And I think people working from home through the COVID experience, if this happened 10 or 15 years ago, it wouldn't affect offices much. But because technology, the internet, 5G, everything is so different now, that most people really like working from home. I work from home. Okay. Most people like that. So office is one sector. I own 6,000 feet of office space. That's it. One tenant's actually occupying it. Second floor of a 2-story building. But I would not want to be in the office space.
Yeah, that makes sense. Yeah, I think industrial. So the industrial really could be the cell phone tower. When you start looking at it.
Cell phone tower, that was a wave, and it's like you're golden if you got one, or some people have many. You're sort of golden because you can't pick up and move it a block down the street. Like, let's say a retailer says, "Oh, I got a better space," or they give me cheaper rent or an office space. Now they have to reconfigure all of the networks and the logistics. It was explained to me, some people in the industry, even if you moved it 500 yards, it's a nightmare to reset everything up. So once they're set, they don't want to go anywhere.
Yeah, those renewals
They
are
don't.
locked,
And
I'm sure.
and if you like talking to one guy in the industry, the one right off the interstate over here, you drive down interstate and it looks like he's got 10 carriers on there. And he's like, we call those Christmas trees because every month is Christmas when that check comes in because they can't pick that up and move it.
Right.
There's no way they can do it. So, anyways, that ship sort of sailed. Technology's going in that industry. Yes, they still need the big cell towers, but now with the 5G and stuff, they're putting on buildings, taller buildings. So you're going to see the growth, I think, go in that sector and not as many on the cell towers.
Yeah.
New cell towers coming up. For some reason, everyone wants their cell phone to work, but no one wants to see a cell tower. It's just,
Right.
You can't have it both ways,
Right.
guys.
Well, I always laugh because you got SpaceX that can land the rocket on a barge out in the ocean, but if you're at a football game and you need to make a call out, it doesn't work. It's mind-boggling to me. It's why the technology is not there when there's a lot of people around.
Yeah.
But
Works when it wants to.
yeah, exactly.
I know you refer to yourself as retired. Do you see yourself doing any more projects, or do you
I'm
think
not
you're
retired. I'm semi-retired.
semi-retired? Okay.
I still have staff. I still oversee them. I'm leaving here to go and meet with some of them right now. And you know what? That's great because my father retired at 55. He was very fortunate. Him and his brother had a supermarket, typical Italian family fight. My dad sold out to his brother, retired, and the light switch went off for him, and he didn't have enough to do. And that's why for me, it's like, God, what would I do if I really just liquidated and, for one, I'd probably lose a lot of that money to Michael playing poker, which we all know wouldn't be a good thing. But then it's like, what do you do? I'm really not that good at golf. So it's good because it keeps your mind in the game a little bit.
Yeah.
And yeah, I'm open. If, Michael said, hey, dude, take a look at this. I got this great opportunity. I'm looking at it. The deals I got involved in North Carolina, they were good at investments. Well, before COVID, they were good at investments. And then after COVID, I got a nice return, an interest rate return. Projects didn't really make much money. But no, I would definitely look at other things.
Nice.
Well, I think having the ability to be retired or not be retired is really what this,
That's the goal.
that's what the,
Yeah.
That's the goal. And everybody's different. I know people like myself, guys who've done way better than I have, and they are workaholics. More power to them. I look at it like, you know what? I lost one of my best friends when I was 40 years old. He was in my wedding, college roommate. And when he died, it hit me a little bit. Here's a guy that GQ looks, great shape, dropped dead, boom, on Harbor Island, and, that hit me. I'm like, you know what? Life's a balance. But you got to give yourself the ability to do things like that when you're in your 50s and 60s. And you got to do that by working hard and working smart. And you got to take risks. If you don't take risks, as long as you're okay with it, that's fine. But don't, like some of my high school buddies, I see them bitch and complain a little bit. I'm like, you never stepped up. You never took a risk. You had a job and it's not for everybody. It's not for everybody.
Yeah.
And most people who do step out, you're gonna have the taste of failure at times. I had taste of failure on my one apartment complex behind Outback here in 07, 08, did a condo conversion. And of course, government permitting took forever and a day, delayed the project a full year. I'm sitting there with 60 empty units. And, we sold one unit and then the light switch turned and I'm like, okay, back to rentals, and that's where we are.
Yeah.
I
have a good buddy, and one of his favorite lines is "Scared money never makes money."
Yeah, no, there's definitely something to that.
That is true.
Andrew and I read a book called Die with Zero, and it was funny because Andrew sent it to me. He's like, "I think this is your mantra," and I'm like, "Oh, real funny, buddy." And when you read it, it's not obviously die with zero, but it's basically live your life now and enjoy the things that you want to do now instead of this idea that I'm going to put that ski trip off until I have X amount of dollars. And then by the time you have that money, now your knees are shot. You can't go skiing anymore.
You're right.
So it's like it's about enjoying the things you want to do now and being able to position yourself so that you can actually do that. And then ultimately, take care of your kids, your family, but die with zero because you can't take it with you.
Right. And I would love to get that book and show it to my 3 daughters and tell them I'm reading it. You're on your own, pal.
Yeah.
But it's a balance, and everybody, people have different perspectives. And again, when I look at it and I hit that point in 2008, I'm watching people go down, then I started looking at projects a couple of years later. And even, I'd say in 2004, I wrapped up 3 developments. And I said, I'm taking a year or 2 off after all the contractor issues and litigation and all that stuff. And then I saw these deals, everything's upside down. And so for a lot of us, 2008 wasn't really that hard to predict, at least on the commercial side, because every deal was, every piece of dirt I looked at was crazy. I can't make these numbers work. And that's why I'm glad I took my approach of just staying smaller, lean and mean, one-man shop for a lot of time, then, some close, trusted employees. And when things got lean, that's it. If there's a failure, it's the man in the mirror that I'm looking at. That's the person I have to blame. And that's why I was a big fan of partners. I've seen too many partnerships fail, and you're friends with both sides, and everyone's pointing the finger at each other. And one of my very, very good friends for many years was part of the one group that did, $300 million a year in construction. He was a minority partner, and they had all these projects going on. I remember seeing the spreadsheets, and they had the jet and the 112-foot boat and this and that, and then I'm like, guys, you got all these projects, but you got so much debt. You got all this. What happens if the music stops? Which is what happened. Mm-hmm. And I don't want to expose myself at that level, especially after you've reached a certain point and you have the kids and everything. I really think this game, for the most part, you got to start young, and you got to sock it away, and you have to learn how to live lean. If you can't live lean, get in another business, do something else, get a job. But if you want to get in this, or hey, if you have an uncle or if you have a rich friend who's going to bankroll your projects, different story. I didn't go that route, because that way, even though I didn't do big projects, they were very profitable projects, and I didn't have to give any of it away.
Yeah.
And I would rather go that route than have 30 projects on the books. Yes, you're spreading risk by doing it, but now you're running around like a crazy man too on 30 projects.
Yeah. I don't know if you have any other questions, but I had one I think is probably a good send-off if you don't have anything else.
Oh, good.
What do you see on the real estate horizon that you are excited about? What are kind of the opportunities that you could see yourself say, man, I'm really looking forward to this potential opportunity?
Well, I'm sort of curious what's going to happen over the next 12 to 18 months. It may be some buying opportunities. I'm not on the single family residential side. I think that market's just crazy, in my opinion. But I think there may be some opportunities out there. The other side tells me it's Tampa, Florida, one of the hottest markets in the country. So we still have a ton of growth, and that growth offsets other things. But there's always opportunity. You just got to dig for it. You got to work hard and smart, and you got to put in your time, and then you'll find them. As far as sectors, I can't tell you in any sectors. I don't think there's been massive overdevelopment. I mean, you could turn the clock back to the 80s, and office buildings were grossly overbuilt. Then you had the 87 tax law changes, which had a huge impact on them. So I don't see that out there. Most development has been like on the retail side, build-to-suits, things of that nature. Now, there are going to be companies that maybe there's build-to-suits and they're going bankrupt. All right. You got car washes being built everywhere. I don't know the numbers behind them. I heard a lot of them are cash cows, but it wasn't too long ago that the storage units were on fire, and then all of a sudden that market got hit. So if you have overdevelopment in any sector, there may be some opportunities to jump in as people are over leveraged.
Yeah.
And we went through a time period where interest rates are low, interest rates are higher. If people have debt revolving and all of a sudden the cash flow isn't there, we've seen how this has played out in the past. So there may be some opportunities out there aside from your typical, just grind it out and find deals.
Yeah.
I think that's it. In any market, if you're finding deals the right way and you're analyzing them, you're making sure they're cash flow positive, uptrends, downtrends, as long as the end goal is hold it, make sure it makes sense for you to maintain cash flow. It really doesn't matter if we do see a decline in the market because you're not selling it.
Right. And again, it has to be a good asset, good tenants, and you have to get in the deal right. I remember a guy who I brokered a deal with, a guy named Leonard Levin. He was at the Helmsley Spear Company. And he was an older guy in New York, and I remember calling him up, and you swear the guy had like 12 phones on his desk, the old style, like in the 30s. And he'd sit there and say, "What do you got, David?" And I would sit there and rattle off shopping centers to him, and he'd tell me every tenant in there, and he knew everything. And he was the one who he sort of educated me a little bit on that whatever you do, buy it right, or don't buy it at all.
Yeah. Yeah, I mean, we hear that all the time that you make your money on the buy, not on the sell. So
yeah.
And
again, you need to, as a younger person in the business, you got to live within your means, so you have the means to take the risks and buy that property and sit there and say, okay, I'm 30 years old. I just bought this little medical building and I'm putting a 15-year mortgage on it, and every nickel that comes out of it, I'm shoving back into it, and then it's paid off in 12 years. And you get 4 or 5 of those, and you're sitting there making, a couple hundred, 300, 400, 500,000 a year. It's like, and you get those $40,000 a month paychecks coming in as you're going golfing or you're going on a hunting trip. It feels pretty good.
Sure.
And I have friends who've been in the industry forever. They don't have one look at real estate. They're older, and they're not doing too well, some of them.
Yeah.
Well, Dave, I appreciate you coming on. It's always inspiring. I know we hang out more socially, and I know you said you give me a lot of your money in poker, so I want to thank you for that.
And I do. I
do appreciate that.
So next time I'm not going to drink as much bourbon when we play. You're going to be in trouble.
Perfect.
And let's do a deal together, man. Let's get a real estate deal going.
Sounds good to me. Well, until next time, this is Michael and Andrew with the Legacy Wealth Code. Stay tuned and click subscribe below, and take part in all of our future podcasts.
Thank you for joining us for another episode of the Legacy Wealth Code podcast. If you enjoyed this episode, click subscribe now and never miss an episode. Until next time, onward.